Good morning and welcome to this Wednesday, December 16th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, looking at Wall Street, had another pretty good day yesterday. We're ready now for the second half of December. First half, usually the weaker half, but we did finish it on a good note. Get into those numbers in just a minute. Futures this morning pointing to some more strength, even with a very weak retail sales report. Surprisingly, retail sales very negative, which I certainly didn't expect, although I guess, there's more reason to think maybe the stimulus package is coming. And maybe that's what the market's going to focus on because we do have futures in the green following a pretty good night overnight in Asia. The Hang Seng was up right around 1%. And this morning in Europe, the DAX is up more than 1%, about 1.3%. So I think some of that strength is carrying over into the U.S. with the green futures. Before we get into any of that, I will take you over to Earnings Beats, especially for those of you that are new to Earnings Beats. And just to make you aware that we do have a free Earnings Beats Digest newsletter. Love to have you join. Enter name, email address, hit the subscribe button. It's completely free, no credit card required. Love to have you. You can unsubscribe at any time. Comes out 3 times a week. Just had one this morning, mostly educational. Talks about earnings, relative strength, and so forth. Anyway, check that out. Would love to have you. We do have thousands of folks that are on our free newsletter. We'd love to have you join as well. If you'd like to try our paid service, this is actually a great time to do it. We do have our normal 30-day trial, which you pay $7, you get it refunded to you in a week. So it's a no-cost trial for 30 days. You can check out our portfolios. That's certainly one part of what we do at Earnings Beats, but we do have a tremendous research and educational platform that we'd love for you to try. The reason it's great time to do it this week is that we do have a special going right now, an annual special. So if you do like what you see and you sign up for 12 months, which already gives you substantial savings, we'll give you 2 free months. So the numbers really, it turns out you pay about 50% off the monthly cost if you subscribe anytime this week for an annual. So it's a great time to check out our service. Also, if you're an annual, you are automatically invited and a seat is saved for you for Market Vision 2021 Rising Above, which will be this Saturday, December 19th, 9 a.m. to 2 p.m. I'm being joined by David Keller, Chief Market Strategist at Stock Charts, and Grayson Rose, who is the Vice President of Operations at Stock Charts. I think, the combination of Earnings Beats and Stock Charts, I think, has been fantastic, especially throughout this pandemic. We're looking forward to 2021. We're both very optimistic, see a lot of good things taking place, and both Dave and Grayson will be here to talk about, not only give their thoughts about the market in 2021, but also talk about what they're looking at in terms of Stock Charts, their products, services, features, tools. And then Dave will specifically talk about Stock Charts TV and what he sees coming in 2021. He's really excited to share that with the Earnings Beats community. So we'd love to have you sign up if you're not already an annual member. If you're a monthly member or a trial member, you'll save $100. The normal cost is going to be $197 for those not in the Earnings Beats membership. Again, if you're an annual member, it's free. It's another $197 savings. So we think this is a great time to try our service. And if you like it, sign up, and then you'll automatically be enrolled for this Market Vision 2021. All right, move on. Let's talk a little bit about yesterday's action. Dow Jones Industrial Average up 1.13%, S&P up 1.29%, the NASDAQ 1.25%, mid caps 2.33%, and small caps 2 2/3%. Another big day across the board, all of our major indices, and we continue to trend above the 20-day, which is above the 50-day. This is the hallmark of another secular bull market advance. I'm not seeing really anything to be concerned about. I know there are folks out there saying, yeah, but we're so overbought. We've come up so far from March. I wouldn't pay a whole lot of attention. I mean, yes, we can, in a secular bull market, you're going to be overbought a lot. And sometimes you're going to have a pullback. And I wish I had a crystal ball and could tell you exactly when those pullbacks are going to occur. But what I can say, based on what I'm seeing, is that if we do have pullbacks, they're going to be shallow. I don't see anything that suggests that we're going to have a deep sell-off. So waiting, the problem is, yesterday we go up more than 1%. So now, if you waited a day, now you got to see the market drop at least another 1% just to get back where it was yesterday. And we're also going into this period of the year, the second half of December, when the market tends to just put its head down. And being in a secular bull market, I'm really not expecting anything big to the downside. Of course, anything can happen, but I'm just giving you my opinion. Energy up 2% yesterday. Once again, and I have not been keeping track of this, but it seems like 30 days in a row that energy has either been the best sector or the worst sector every day. It seems like it's been on that. Maybe I should go back and watch these trading places live for the last, well, I wouldn't have Fridays, but I could still go back Monday through Thursday and see where energy has been sitting. But I believe it has been first or last for about a month straight now. Maybe I'm just exaggerating. But anyway, energy was the strongest sector on Tuesday, and then utilities second strongest, up almost 2%. And I wrote about this a little bit. I think it was in the daily market report yesterday, because I had an email from a member that, utilities were having a good day and were leading throughout much of the day yesterday. And the member said, isn't this a bad sign? We're moving up. You said when defensive groups lead the market, it's bad, and utilities were leading. Well, don't take everything I say completely literal. What I really mean is when you've got to advance, not just one day, but I mean, if we go up for the next, over the next couple of months, and utilities on a relative basis are breaking out to the upside and leading to the market, yes, that would bother me. We're not talking about that. Look what utilities have been doing for the last month and a half, going down. The market's been going up. I can promise you, utilities on a relative basis have not been very strong. A bull market, another hallmark of a bull market is wide participation. We want everything going up. And the reason for that is you don't want the bears to have anywhere to turn. You want everything looking bullish technically. And so even utilities, when it was going down, we had a negative divergence on this high, by the way, higher prices in November, lower PPO. And I even suggested at the time we could see a 50-day test, which we did. We went a little bit below it, but we held on to the price support, and we were down around 61.5, 62. I suggested that at least I thought we'd probably bounce off of that. I wanted to bounce off of that. We're off, this is a support area, and we've been weak for a while, underperforming. It's okay if utilities bounce and even lead the market for a period of time. Now, if they just took off and the market keeps going up, and utilities and consumer staples and healthcare and those areas, real estate, lead the market, then we'd have a problem. But that is not at all what we're seeing. So I don't worry about one day here, one day there. Staples, the worst performer yesterday, but notice they were up. All 11 sectors advanced yesterday. So very strong day in the market. Renewable energy went right back to the forefront. You can see up almost 7% yesterday. So after pulling back, look at that 20-day moving average at the high, at the recent high. Where was the PPO? Moving higher, moving to a new high. So that combination tells me that when we get a pullback, odds are, no guarantees, odds are we're going to see a 20-day bounce. And sure enough, we went down, hit the 20-day, we bounced a little bit, came back down, hit the 20-day, and now we're bouncing back. I would expect renewable energy to continue to perform well and at least get back up to challenge that earlier high back in late November. Tobacco had been on a roll to the upside, but it was the worst performer yesterday at 0.71% loss. There weren't many groups that actually lost ground. So that was kind of interesting just to go looking for the just to look for what was not working, because there wasn't a whole lot to find. There weren't a lot of areas in that that area or whatever of the market performing like that. All right, let's talk a little bit about the 10-year Treasury yield. We did have retail sales out. It was not pretty. November retail sales dropped 1.1%. The market was expecting a drop of 0.3%, so almost quadrupled the estimate on Wall Street. Retail sales, if we exclude autos, dropped 0.9%. The market was actually expecting a gain of 0.1%. Ordinarily, if I see that, I would have gone and thought, well, the Treasury yield's down. Money is going to be rotating into Treasuries. You know, that's a pretty bad economic report. Retail sales are a pretty big deal. And I was surprised. 10-year Treasury yield up 2.5 basis points. And if this doesn't underscore the market that we're in, I don't know really what does. Money rotating out of Treasuries with a horrible retail sales report. To me, this tells me the market is focused much more on what we have ahead than it is on what we just saw in the last month. So clearly the market is expecting these numbers to pick up in retail sales as we go forward. And it'll be very interesting to see how this impacts retailers today. Let's look at the various retail groups and see if they're impacted. If they're not impacted by a direct economic report in their industry that is so weak, I think it's pretty obvious then that the market is completely ignoring last month's numbers and looking ahead. So that'll be interesting to watch the balance of today. What happens to retail stocks? So look at the specialty retailers, the broadline retailers. Look at something like the XRT, which is just a widely diversified retail ETF. It's been in a beautiful uptrend. Does it go below that 20-day moving average? Based on what I'm seeing and looking at how the market's reacting or how the bond market's reacting, my guess is it's going to hold that 20-day. If it does go down there, probably going to bounce right off of it. Really nice action taking place in the XRT lately. All right, let's move on. And I want to talk a little bit. I got another question from a member, and I thought this would work out well for talking technically. And the question essentially is what to expect from Tesla. You know, it's being added to the S&P 500 on December 21st. It's in our model portfolio. We've been riding it up since our November 19th date. Actually, we've had Tesla in our portfolios for quite a while. Tesla is one of my favorite stocks, and it's pretty easy to understand why. Tesla, relative to the autos, it's a leader. And you think, okay, well, it's a leader in autos. Well, autos are killing the S&P 500. Automobiles arguably are the best performing industry group, and Tesla is a leader. Now, being added to the S&P 500, it's kind of hard to come up with a negative thought on how that's going to negatively impact the stock. I mean, automatically, you've got a lot more demand when a company is added to any index because you've got tracking ETFs that then have to buy that stock. And we've seen that. I mean, Tesla announced, I don't know exactly when the announcement was. Was it back in November? That I didn't think it was that far back, but for some reason, I'm thinking it was with the breakout or maybe just after this breakout. And we had been in a triangle on Tesla. You can see the triangle off of an uptrend, lower highs, higher lows. That's a symmetrical triangle, which is a bullish pattern following an uptrend. It's a continuation pattern. A continuation pattern means that when you break out of it, you expect to break to the upside because you expect to break in the direction of the prior trend. And with Tesla, that was higher. So we moved up, ascending triangle, or excuse me, symmetrical triangle, and then we break out. Look at the volume pickup on that breakout. I think everything looks good. AD line looks good. All the relative strength lines look good. I really have a problem finding anything wrong with Tesla. Now, anybody who's bearish will look first to the fundamentals and say, well, they just don't justify this valuation. Well, neither did Amazon. And to be quite honest, I went years without buying Amazon for that very reason. It was the fundamentals at my core of my being a former practicing CPA. Amazon went a long time without earnings, and I could not justify how they were ever going to make money. They kept losing money and they kept giving stuff away. Well, I was certainly proven to be the fool. And so I'm not saying it was at that time, because I've been a follower of technical analysis for a long, long time. But it was probably about that time that I really began to look at relative strength. And I started ignoring technicals when when Wall Street was telling me to buy a stock. And I'm not talking about just because it goes up a day or two, some of these high flyers, these $5 stocks have become $12 in a week. I'm not saying, hey, go jump out on that because it's gone up so much in the last week. But I'm talking about a steady relative strength that where the line's been going up. You're in a good industry group and the stock continues to outperform. I think it's time to consider the technicals more than the fundamentals, because I would agree with most, anyone who says, hey, Tesla's fundamentals don't support their valuation. I would agree with you. I can't point to their revenues or their bottom line and say they justify their huge market cap. I mean, that makes absolutely or very little sense to me. But it keeps going higher and it keeps going higher. So at some point, I think it's worth listening to what Wall Street is telling us. And I think that's the case with Tesla. Now, Tesla, unlike Amazon, is starting to show tremendous earnings growth, and they're beating estimates. They're raising guidance. And the stock market, you can value companies on the things that make you feel good, their balance sheet, their book value. Some companies are will always be valued something like 2 times book or 2.5 times book value or whatever. But there are other companies that grow their earnings so rapidly that you've got to value them based on their earnings growth, not based on their book value. So and again, I think Tesla kind of fits into that category. So I would hesitate. Now, if you're somebody who's really conservative, you're retired, you're living on fixed income, should you go out and put 10 or 20% of your money into Tesla? Of course not. Again, they're based on their future earnings. If all of a sudden Tesla comes out and says, you know what, we're just not going to be able to meet those estimates, and we're going to lower our guidance for the next year, well, the valuation of Tesla would come down quite a bit because it is based on those. It'd be like blocks crumbling beneath you, because that's what is driving the Tesla price. Okay, so you have to understand that. You have to understand it's a big growth story, and I believe that if they're going to miss earnings, we're going to see it begin to show up in the charts before they announce it. Wall Street will get wind of it. They meet with management. Management will start telling them things that, hey, well, we're seeing a little slowdown in this area or something. Wall Street will begin to get a sniff of things not working out, and you will begin to see the stock being sold, not consolidating, but literally breaking down below moving averages. You're going to see the relative strength line start to go down. If Tesla just drops a bomb and nobody sees it coming, then Wall Street's not going to be happy with management. It's a stock that's probably going to be out of favor for quite a while. They do rely quite a bit on the trustworthiness of management, of telling them what's going on in their business and not just dropping a bomb, because they've got billions of money invested for their clients. Don't tell me that you're running ahead of schedule and then all of a sudden say, oh, we're not going to meet our estimates. Because, how would you feel? You're not going to trust a management team that does that. All right. So anyway, that's Tesla. So the question was, what do we do? Tesla is going to be added to the S&P 500 on December 21st, which is now less than a week away. What's going to happen to the stock? Well, I don't have a crystal ball. I'm not sure what's going to happen to the stock. I can only tell you what's been happening and the fact that it's a leader on Wall Street. And I think if it gets sold off, you're going to have folks jumping back in. So I wouldn't look at it much different than I look at it now. I look at it and I say, well, 20-day test would be great entry, but it's in a nice uptrend. I mean, it doesn't mean it has to come down and test its 20-day. It may just keep going. I mean, you can see here we pulled away from the 20-day, and it was another 3 weeks before we tested the 20-day. Here we broke out, again, another 3 weeks before we tested the 20-day. Here, you can see we were going up for months, never tested the 20-day. So, we just had a 20-day test. My guess is it continues to go higher. If the market's bullish, I think Tesla leads. Now, one other thing that you can consider is They do this every 3 months. You can go back in history and find out what was added to the S&P 500. Take a look, see what has happened in the past with companies. Now, I think a lot of it depends on market environment. Right now we're in a really good market environment, even with bad retail sales market looking to open higher. I think it just underscores the really bullish environment that we have right now. The last time that stocks were announced, we had topped right around that time when the announcement was made. And the three companies that were added, one was Etsy. This was back in September. So on September 4th, Etsy was added, which was over the weekend. And so the 8th, I think they were added on a Friday evening after the market closed. And that was Labor Day weekend. So the 8th was the Tuesday to follow. So they announced on Friday evening. Etsy actually opened about even for the day. And you might think, wow, it didn't get much of a reaction. Well, think about what the market was doing. I mean, on September 8th, remember, we were taking a pretty big hit. The Qs were down about $7 or about $15, $12. Can't tell what that number is. Let's go back here and let's see if I go back 6 months. Probably only need 4. Get a little bit closer look at this. So right here, so we were, I don't know, 283 and we opened at 272. We opened down $11 on the Q that day, on that Tuesday after Labor Day. It was a really bad day. The Spider opened down, from 342 down to about 335 and change, $6-7, 2%. So that was probably one of the weakest opens we've seen. So now when you look at Etsy, you got to keep that in mind. I mean, the market was getting hammered that day. Etsy that day actually gapped up a little bit. It opened positive on a very, very weak day and then kind of went down and retested. This was after the announcement. It actually got added on the 21st. The announcement came back here when it was trading at 113. So after the announcement and it was added, you can see Etsy made a pretty good run. And what was really funny is I remember when the announcement came out, I think it was Investopedia. You could probably Google me and find out if it was Investopedia. But a writer at Investopedia said that Etsy, they didn't understand why Etsy was being added, why Teradyne was being added, or Catalent. Those were the three that got added because they all appeared to be in very poor shape technically, and they didn't expect these stocks to go anywhere. Well, Etsy was added on September 21st, and that was at 110. Well, when it was added, or when it was announced it was added, it was around 113. And then when it was actually added the morning of, it was about 111. Now it's 177. So I just chuckle when I see these analysts talk about Etsy not being in a very good position. I mean, if you look at a weekly chart back in September, I mean, here we were in September on a weekly chart. PPO was at a high. We pulled back. Of course, it was very extended. My gosh, 20. It was definitely overbought, but this was not a bad stock. It was pulling back, and it was hitting the rising 20-week moving average while they were saying that it had, horrible technicals. And I don't even know what to say sometimes. But anyway, Etsy bounced, as we might expect, off of that weekly 20-week test and has continued rising. And stock's up now, 60% since September. That was since it was added. So I'd say things worked out pretty well for that stock after being added. Teradyne. And this one, they kind of talked about it in Investopedia, that this was the worst of the bunch. They really couldn't understand this because the stock long-term had gone up and down and in a yo-yo or whatever. And so again, this one gapped down with its announcement, probably not quite as much as the market, but it was still down. And then we went sideways. And then on the 21st is when it was added. And look at what's happened since then. So the stock's gone up about 60% since it was added. And then the final one was CTLT. And CTLT gapped down when it was added. But again, market was kind of dictating that. And went down basically double bottom. But on the 21st right here is where it was physically added. It was at $86. Now it's at 100, so it hasn't done as well as the other two. But it's had its moments. It's starting to strengthen again. But I would say all three of these stocks, after being added to the S&P 500, they moved higher. And they had gone up quite a bit. So the question that came into me is, since Tesla's been added and it's already made this big move, should we just count on the fact it's going to come back down? And I don't think I would, draw that conclusion. Sure, it can come down. The stock's been going crazy. So, any stock that's been up as much as a stock like Tesla can pull back and consolidate at any time. But from a longer term perspective, I really like what I'm seeing in Tesla. So I would want to continue to own it. That's my thought. All right, let's talk a little bit about the strong earnings chart list. This is one of the features we offer to members, paying members or trial members. You can take this entire strong earnings chart list, which, by the way, right now, if we show it in edit form, 499 companies are on this chart list. These are all companies that have beaten Wall Street estimates as to both revenues and earnings per share in their last quarter. And they look good technically, and they're liquid, in my opinion, that they trade at least an average of about 200,000 shares a day or more. And there's 500 of them on here right now. And when you pull this up in summary form, any of our chart lists, you can quickly look and see, okay, this is what was leading, or this is what led yesterday. These are the stocks. FTEK went up 16%. This is up 15%. So you might want to know, hey, give me the fundamentally strong stocks that are performing well today, and there they are. Or you might say, well, give me the weak ones. There they are. You might say, well, what about which ones have the highest scooter score? Well, there they are. Which ones are in discretionary with the highest scooter score? Well, you go down here, you sort it by sector. There's discretionary. Tesla's number 1, CPRI 2, Tupperware 3rd, L Brands 4th, and they're listed. There's so many different things you can do with the chart list to help you find individual trades. Look at internet stocks, Pins, Snap, Upwork, the 3 highest, Scooter. These 3 are all in our portfolios. There's 3 of our 40 stocks right there. And if you look back over the last month, and you'll see Snap up 27%. Actually, let's do Scooter. And then this sector again. Communication services. Okay, so here's Pinterest over the last month, up 13%. Snap, 27%. Upwork, 22.5%. I mean, if you want to know why our portfolios outperform or have been outperforming, it's because we pick leaders and we just let them do their thing. Some won't work out, but some, like these 3 internet stocks, will help carry a portfolio. I mean, again, going back to these numbers on the portfolios, I mean, look at the model portfolio this quarter, up 14.96%. Well, one of the reasons when we look, let me see if I can pull this up here. One of the reasons is Snap is in our model portfolio. It's one of our 10 equal weighted stocks. It's up 27% the last quarter. Snap clearly is one of our leaders. So anyhow, but you can use our strong earnings chart list in a number of ways. That's one way. You could go into the dashboard, and this is what a lot of our members do. We've got scans that we have on our website at Earnings Beats. And one of them, for instance, is a downtrend reversal scan where you can edit. And I've got mine set up to run a scan against these 4 chart lists right now. So I've got mine saved. Now, if you try to run this in your own account, it's not going to work, because in my chart list at Stock Charts, my strong earnings account is favorites list number 54. If you've downloaded strong earnings, first of all, if you don't have strong earnings chart list in your Stock Charts account, then there's no way it can go in and run a scan against it, because it can't find anything. But even if you do have the strong earnings chart list downloaded into your account, it's probably a list number that's different than 54. So this is specific to my account. If you want to go in and run this scan, you could copy this part of it and put it in the scan syntax, and then you'd have to go down and grab your own chart lists, because they're all going to have a different number than mine. See how mine says list number 54? If you do this in your account, it's probably going to say list number something else. Strong future earnings 114. Now, if you happen to have chart list number 54 in your account, it's going to pull that one up. Probably won't be your strong earnings, but it could be who knows what. Maybe you downloaded your S&P 500 components into your account. Maybe that's list 54. Then that's what it would run it against. It's going to run whatever it shows in your account as number 54. And I bring this up. I know some of you are familiar with it, but I bring this up because I get a lot of questions, because I'll bring up a scan like this and someone will copy it. They'll take a picture of it or whatever, and they'll run the exact same scan in their account. And they're like, well, I didn't get the same results you got. Well, again, because you don't have the same chart lists in your account. They're not labeled the same way in stock charts the way mine is labeled. So it's based on your favorites list. That's how stock charts reads these chart lists, not by the name of the chart list. Okay. But anyway, I can run this and I can do this as of today, for instance. Now it's probably, could have something come up. Essentially what this is it's a scan where you've gone down. You've had 5 days in a row where a stock's daily high is below the prior day's high. But then in the current session, the daily high is greater than the prior day's high. So in other words, just kind of picture it in your mind. You're going down your lower highs for 5 days in a row, and now you got a higher high. Could be a downtrend reversal. So if I run that, I doubt there's anything today so far, but you never know. Let me see what we got here. We'll run this. Actually, I always check syntax first, which is good, and then run scan. 3 of them. Well, imagine that. All right. So guess what? For the 3 you must see, here they are. I'm going to go ahead and run through them and just see what they look like. Haven't looked at them. Let's try Alibaba first. And Alibaba trending lower. It does have a double bottom. Now, if it could get back up above 280 and break out, that'd be very bullish. But you can see why it's on the scan. Let me just go back and show you this close up. We'll just do 1 month so you can see this really easily. But starting here was a lower high, day 1. Day 2 of lower high, day 3 of lower high, day 4 of lower high, day 5 of lower high. Today we have a higher high. And Alibaba just hit support. This is an interesting level because if it breaks below 252.5, you get out. Now, sometimes they open strong and then they pull back and then they come back up again. So if I was looking at this from a downtrend reversal standpoint and I wanted to take a shot on Alibaba, I'd probably buy maybe a half of my position. And if it pulled back somewhere in the middle of this candle body, 255, 254 and change, maybe I'd fill out my position. And then I literally would keep a stop below these 2 lows. Maybe it's right below it. Maybe you give it a little bit of room, a half percent, maybe a buck and a quarter below, something like that. So that if it really turns back down and negates this pattern, then you get out really almost unscathed, not a whole lot of loss. But if you're right, and especially I like these if they're in bullish patterns. If we had been going up, maybe you had a negative divergence, we just pulled back, hit a key support level. Maybe that was also the 50-day moving average, and the PPO went back to the center line. And then I saw this reversal. That would be much, much stronger of a play for me than this one. Because this one, if you look, relative strength's weak. Stock's been going down on big volume. Yeah, it could bounce, but it might just go up to the 20-day and then turn right back down to the downside because it has been trending lower and it's been a weak performer. And that's another reason why, by the way, if it did break down, I wouldn't make any excuses for it. I would be out. No excuses. You got a downtrend. You got a really poor stock on a relative basis versus the broadline retailers. Volume trends are weak. To be quite honest, I wouldn't take this trade because of all the things that are negative here. I'm just saying if I did, and if I was counting on a little bit of a bounce here and that's all I wanted, just make sure you keep your stop in play. Double bottom breakdown with everything else going on here would not be particularly good. All right, next up would be Macy's. Macy's, another broadline retailers. Now, this one looks much different to me, and I do like this one. Here we've been moving up. We pull back. We hit the 20-day, get close to that. This is almost what I was just talking about, except it was 20-day instead of the 50-day. Volume trends are much stronger here. AD line, which had been downtrending, starting to show some strength. Relative strength coming off the bottom. We just went to about a 7 to 8 month relative high on Macy's. So to me, between the two, I'd be much more of a fan of Macy's. Trading above the 20, above the 50 as a bullish, somebody who likes to trade a trend to the upside, I like what I'm seeing on Macy's. But I would, again, look at the same thing. I'd be thinking about, okay, maybe I get in half a position. And if you look at maybe a 5-day chart, you can see now it looks like we've been downtrending. Now we're starting an uptrend. But sometimes we get these pullbacks, little head fakes. Maybe it comes back to 1060, something like that. So I'd keep a little powder dry, and then I would bank on the fact that we're reversing. So I'd have my position filled out, and then I'd be watching down around this 1030 level. We could go back to that daily chart. The 20-day moving average, 1042. I mean, if you wanted to take a little bit more risk, you could say, okay, I'm going to hold it as long as it closes above its 20-day. So that means intraday, even if it went down below 1042, you're going to hold it until late in the afternoon and see if you get that reversal. So it does create more risk because maybe it breaks down and goes to 950. And then obviously you got a much bigger loss. So you got to decide if you're willing to take that additional risk. All right. But Macy's, I think, looks a lot better than Alibaba. And the last one, YCBD, and then we'll wrap this up. This one's been going down for 5 days. It's still in an uptrend, trying to hang on right around. Nice reversing candle yesterday, by the way. It looks like a piercing candle. The group has been strong, but this has not been a great stock within the group. Also, let's see what this volume looks like down here, because we've had a couple of really big volume days. But over here, no, volume's not as light as I thought. There was a kind of a low volume day, which was 400,000. There's 400,000, 400,000. Yeah, these are all 400. So it looks like even the smallest volume day is 400,000. So I'm not worried about the volume. Like I said, we're moving up. Notice at the tops here, there's a dark cloud cover. That's a reversing candle. At this top, that's a bearish engulfing candle. Then at this bottom, it looks like we got a little piercing candle, and now we're putting in a higher high. This is an interesting stock for sure. I would, I'm probably not going to do it just because it's a $2 stock. But if that's your cup of tea, getting in and maybe, again, if a little weakness, maybe down to 266, 268, you're counting on this starting an uptrend. But that doesn't mean it's just going to go up all day long. It could still pull back for a half hour, an hour, hour and a half, for six more cents, 7, 8 cents, I don't know. And then after that, turn back to the upside. Remember, on the big chart, the daily chart, you're counting on the reversal. On an intraday chart, you could still see a little weakness as long as you don't go below that prior day's low. So that's probably my favorite scan, to be honest, is the downtrend reversal. And just seeing what these charts look like. Macy's comes right up. I mean, there's 1 of 3 charts. You look at it, Macy's, again, maybe Macy's goes down and gets stopped out, but I like the fact that it's been leading the market to the upside. It's had a stellar run. It pulled back. We like to see profit taking. I want to see, I'd rather go to the store and buy a shirt that's 20% off than to say, I'm going to wait until they take the sale price off. I'm going to go ahead and I'd rather get it. I'd rather get this shirt for $40. I'm, $32. I don't know. Something seems wrong with it. Let me wait. I mean, that's really what you're doing with stocks. When you get a good stock and it's pulled back and it's at a key support level, it looks better. Should. You should like it better. All right, let's see what the market's doing, and we'll wrap this thing up. Running a little bit late here. Dow down 66, S&P down 5, NASDAQ down 11 and 2/3. So even after the strong, futures were up. They weren't, I wouldn't say they were strong, but they were up a little bit. But we've seen it reverse a little bit here at the open. So the Dow, like I said, down 66, S&P down a little, and then you've got the NASDAQ down. Small caps, mid caps, both are up fractionally though. So not bad. Looking at the Dow, Home Depot off to a decent start. Not looking so good. CVX, I don't know, maybe that's a sign energy's down at this point, and so forth. So anyway, that's it for today. I want to wish everybody a great day. I'll be back tomorrow to do the next Trading Places live over at Stock Charts. That'll be tomorrow at 9 a.m. Hope you can make it. Until then, happy trading.